Yeah, so sales activity is way down in some markets by almost 40%. So realtors, title companies, lenders, escrow companies, all of these related industries to sales volume are definitely feeling the pinch. They are suffering because of that. And there are knock-on effects because when people buy properties, they also tend to buy furniture and appliances and paint and home improvement and, hire contractors and landscaping and all sorts of things. And that's why real estate is such a big, incredibly important part of the economy. And the government will do anything they can, Jasper, to stimulate the real estate market. However, more recently, our central bank, the Federal Reserve, and other central banks around the world have been trying to cool inflation, and they have jacked up interest rates at a historic pace. And that has been a pretty painful prescription for the market. But one of the things that is incredibly important to understand, and this is super important that everybody understand this, there is a huge difference between sales volume and sales prices. I have addressed sales volume so far, and that has caused some people to predict that there's going to be some big crash in prices. And these two are sometimes related, but they are not necessarily related. And we can dive in and really look into that today. There's a lot of sort of layers to peel off on that onion, if you will. And I'm happy to go down that path and do that. But we must understand they are not necessarily connected. Sometimes they are. This time, they're not so far very connected.
Right. Well, let's talk about this. Like the interest rate's gone up from 0 to what is it, 4.5-ish percent?
Yeah, that's not the mortgage rate, but yes, when we look at the rates that sort of determine mortgage rates, but I think it's more important to talk about mortgage rates because that's what everybody really feels. And so, we saw mortgage rates that were literally at a 5,000-year low. I kid you not. There is data on interest rates going back 5,000 years. Okay. Great book recommendation. The book is called Debt: The First 5,000 Years by the late David Graeber. It's an excellent read. I would highly recommend it. So during the COVID era, we saw incredible efforts by the Federal Reserve and other central banks around the world to stimulate the economy by basically making money free. And the cost of money went to zero for all intents and purposes. Why do I say that? Because when you look at the inflation rate versus the cost of money rate, the cost to borrow it, you have to take those two things into account. And so if the inflation rate is, for example, 5%, and the interest rate on a mortgage is 3%, then you're getting paid 2% to borrow the money because you're borrowing below the rate of inflation. So that's a negative interest rate you're getting paid to borrow, essentially. That's an incredible deal. It made a lot of people, including myself, very rich during the COVID era. Now that time is actually still with us. I know a lot of people might think, are you kidding me, Jason? No, it's not still with us because now rates are much higher. No, it is still with us, actually, because the stated inflation rate is, it keeps moving around. So I'll just use a sort of a reasonable estimation of the consumer price index at 8%. Okay, let's go with 8% as the CPI, bumps up and down each month. There's a new report, but let's go with 8%. You can borrow on a mortgage at a little less than 6%. Okay, so you're still getting paid to borrow money. We still have negative interest rates. And there is a school of thought that as long as we have negative interest rates, it will be impossible to tame inflation. And the Federal Reserve, their target inflation rate is 2%. Now, Jerome Powell, during the COVID era said he didn't care about 2% anymore. It was out the window. Okay. And what the Fed is trying to do, because we live in a managed economy, unfortunately, I don't like this. I think it's It's bad. I don't really think there should be a central bank. I think the market forces should set the cost of money and the cost of borrowing. But we have what we have, and it's not likely to change anytime soon. So these central planners that run the economy at the Federal Reserve and the European Central Bank and the Bank of Japan and all of the central banks around the world, they coordinate, or you could say collude, because they do. And they're basically trying to manage what's called the Phillips curve. And the Phillips curve is this economic indicator that balances inflation with unemployment. And they want to get to a 2% inflation rate, but keep unemployment reasonable as well so that people can get a job. And what they're literally trying to do now, they have stated this, and this is the problem maybe with central planning, one of many, is they are trying to make people unemployed. They keep saying the unemployment rate is too low. We've got to put you out of a job. Okay. We've got to make you unemployed to fix the economy. Because when you have very low unemployment and you have wage inflation where salaries keep going up, it is almost impossible to tame the inflation beast when you have that. Because, the classic example of inflation is a increased supply of currency units, in our case, dollars, chasing a limited supply of goods and services. And with the supply chain constraints that we had over the past few years, and it caused Chairman Powell to constantly use the word transitory, to say inflation is transitory. It's just a result of supply chain issues. And as soon as those bottlenecks loosen up and the supply chain is healthy again, where goods and services can move through the economy more quickly and around the world more efficiently again, then inflation will go down. Now, look, to be fair to Powell, some of that was certainly true. He was not wrong about that completely. But anybody with any degree of common sense would just have to know that when you pump trillions and trillions and trillions of new dollars into any system, and you have a limited supply of goods and services, you're going to have inflation because you have more dollars chasing that limited supply. And so all the suppliers are going to raise their prices, obviously. And that's just the way supply and demand works. It's the most fundamental law of economics. So the Fed is in a very difficult spot right now. They have completely f***ed this up. I'm just going to use the word, okay? Because it's punctuation. They have messed up so badly by letting the economy run hot for way too long. They should have raised rates much sooner. They should have tightened the money supply much sooner, but they didn't. And so now we are all paying for it with increased inflation. Now, listen, philosophically, I hate inflation, but from my own personal standpoint and my own personal greed, I love inflation. And for our investors, I love inflation because I teach a strategy called inflation-induced debt destruction, which I trademarked many, many years ago. And it is the hidden wealth creator that helps people with their real estate investments create wealth by basically letting inflation pay off their debt. And very few people actually understand it or pay attention to it, but it is really an incredibly powerful tool. In addition to all of the other benefits of income property, inflation-induced debt destruction is a real bonus for that.